Hello and welcome back to the Note, back in the old format for a day today, and it feels really quite a bit like the old days of 2008 and 2009. We've had arguably the scariest day on world markets since the crisis began to abate. I'll quickly try to tell you the story of what happened and then try to give some guidelines as to what might happen next. Now, as ever, it all started in China. Shanghai had yet another sell-off. Shanghai Composite is now actually down for the year. Japan also had an ugly sell-off. That sell-off continued across European stock markets, and then we came to the open here in the US, where the big headline number after a very exciting beginning to the day's trading was that the Dow Jones Industrials was actually down more than 1,000 points at the open. After that, let's take a look at the intraday movement for the S&P, and you can see we've had a very variable, very strange day, which ended with the S&P down badly and indeed in a correction. We are at last more than 10% down from the high. If you want to look at this on a sectoral basis, you can see that this was in no way a discriminate sell-off. Everything went. I think you can look at that very strange opening as a clear sign that a few people needed to sell to raise cash. Therefore, the stuff that was easiest to sell, the bigger liquid stocks, got sold the most, but everything got sold. This isn't about spotting particular anomalies in particular stocks. It's about getting out of stocks so that you can raise some money. Now, that money didn't particularly go to bonds. This is the 10-year Treasury yield over the course of the day, and you can see that at one point it looked as though we were having a classic out of stocks into bonds day with the bond yield down some 10 basis points. It came all the way back. After China, the single biggest driver of what is going on is oil. China and the demand factor is important there, but there are other supply factors that are important to the weakness of the oil price. And as you can see, this is Brent crude we're looking at. The price action in oil was significant and does look as though it's fundamentally driven steadily but surely. People wanted to get out of the oil market. That was a big driver. Energy was the worst performing sector, and that's why the global stock market, the all-world index, as far as the FTSE is concerned, is now in a full-blown correction. Now, what is going to happen next? Plainly, one very big element is what the Chinese authorities have up their sleeve. If they can come up with a new package to stimulate their economy and that convinces the market, that will have a huge effect. But there is one other very important player in here, which is the Federal Reserve. They are talking at Jackson Hole at the end of this week, and they have a meeting next month at which they've prepared the market for the likelihood that they will be raising rates for the first time in 9 years. The market plainly thinks that is less likely than they did. First of all, take a look at inflation break-evens derived from the bond market. According to the market at this point, the likelihood is that inflation in this country, in the US, will average just under 1.5% over the next decade. This is not just about lower oil prices, which will obviously reduce inflation in the short term. That is as low as it's been since the very worst days of the crisis. It's worse than it was at two separate points over the post-crisis period, when a fall in break-evens, a fall in inflation expectations was enough to prompt the Fed into fresh rounds of QE bonds purchases. Yes, the Fed needs to take account of unemployment, and unemployment really gives no reason to have emergency low rates, even if unemployment's not improving at any great rate anymore. But it also has to concern itself with inflation, and there is no reason at all from inflation to be raising rates now. Secondly, take a look at the foreign exchange market, and counterintuitively, the dollar, even though it is a safe haven in these climes, has absolutely tanked against the standard narrow measure of its trade-weighted index against the other big currencies such as the yen and the euro. It's against both the yen and the euro, it's about as weak as it's been in about a year. Why would that be the case? That's because the expectation now is that the Fed won't be raising rates in September. That expectation of those higher rates had been attracting capital to the US from those other developed market currencies. If you take a look at the broader trade-weighted exchange rate, including currencies that are much more closely tied to commodities such as oil, you can see that the dollar has been much stronger of late. The reason for that dichotomy is that people expect commodities to stay weak, but because of that, they expect the Fed not to raise rates and therefore to weaken against the developed markets. Now, if the market is right about this, then Jackson Hole and obviously the September meeting become very important. If the Fed does make life a little easier, then there are precedents, most recently 2013 after the taper tantrum, but also in 1998 after the Russian crisis, when easier, softer policy from the Fed than people had been expecting has seen a nasty emerging markets driven sell-off abate. I think that is what markets are expecting, but there are plenty of opportunities for that story to go wrong.